All right, Justin, we're going to be talking about all things chronic illness riders and accelerated death benefits. I know it's a very exciting topic, but we're going to be covering what it is, what it's not. We're also going to be covering some of the top whole life insurance carriers and how they look at them and ultimately how these riders work. Very much like paid up addition riders and even like guarantees and other benefits that you get with life insurance. Not all companies are created equal, and they have different approaches as it relates to this. So, Justin, before we get into the presentation, the very exciting, I should say, presentation that you built for us, I want to just take a step back. And if we were in an elevator and someone were to ask, what is a chronic illness rider? Which, for the record, has never happened in my entire life. So just to be clear, but if that was the case and we only had like 30 seconds, I would just say these type of riders allow you to spend a portion of your death benefit while you're alive if certain events trigger. And like always, it's an option. It might not be the thing that is the end all be all, but we do believe at Better Wealth more options are better than less options. And this has been something that I've known of people that have taken advantage. And for everyone that has taken advantage of a rider, it was very meaningful at the time that they did. So without further ado, let's jump in.
Yeah, let's do it. And I don't know about you, people don't ask you about chronic illness riders in elevators. It happens at least twice a year to me. So I don't
Okay,
getting
well,
the
you
wrong
have a way more
getting
exciting life.
the wrong but yeah, no, it's a something most people know about chronic illness riders, accelerated death benefits, because we've talked about it, right? They're like, oh, that's cool. That's an added benefit. But it's important to know, to me, at least a few of the ways that it works. Because to be honest, if you're having to use one of the riders, you're probably not in a good place to remember how it all works and stuff. And that's what we were here for if that did come about. But yeah, there's definitely an added benefit there. And I say it's a free rider for the most part, but it's not a free benefit, as we'll actually dive into here. And so one biggest thing of what they actually are is just going to be, well, it's a way you can accelerate your death benefit. So to accelerate, you don't have to die, and you actually get access to be able to utilize that death benefit. Yes, you have access to cash value all along, which is a way of getting, think of that equity in your death benefit. But this is specifically geared towards the death benefit. You accelerate that, get access to it rather than having to die there. And there's typically three different ways that these are attached to a policy. For the most part, any policy is going to have a terminal illness rider. So terminal, think, hey, you have less than a year to live. Doctor's diagnosis, you can't just go in and tell the life insurance company, hey, I have less than a year to live. You actually have to have proof from a doctor. And occasionally they may have a third party doctor review that and different things like that. But that's going to be option one. Pretty much all the carriers are going to have that, and you'll be able to qualify for that. Now, option two is chronic illness. So think, hey, you're not going to die necessarily anytime soon, but you may need some care. You can't do two of six activities of daily living, is what that's going to be about. And each company has a little different wording on how they talk about that. But that's the thing, hey, you need some care, and that could be in home, could be in a nursing home, could be short term, long term. But that's going to be the trigger for that one. And then you have the actual long term care. So any of these other two, they're attached on there. It's not a true long-term care. There are companies that you can get a actual long-term care rider with, and it's going to be a little bit different, as you'll see as we actually dive into it. So how it works, pretty simple when you think accelerated death benefit. Well, it's going to advance part of the death benefit, right? I think most people understand that. The big reasons there creates that liquidity. It can be paid, which is important here. You can get a lump sum at some companies, depending on how they do it, a bigger lump sum than what you could get if you just took the monthly income. And it does actually reduce the death benefit. So again, it's a free rider for the most part, but it's not a free benefit. When you activate the benefit, you're going to be paying for that in one way or another there. So every dollar advanced is going to lower your death benefit by more than probably what you paid. There's going to be loan build up, depending on how they do that. It may just lower the death benefit accordingly. And to be honest, a lot of them have an activation charge. So maybe $100, maybe $500. But when you actually go to use it, well, you got to pay to do that, which is kind of funny there. I mean, they could just take that out of there, but it's a small charge, but good to know there.
Yeah, and it's my understanding that we're gonna break down the actual examples of that because yes, it's something
Yeah,
that's included, so it's not a lot of times that you have to pay extra to have this option, but if you were to
yeah,
trigger this option, um, hypothetically, if you needed $200,000 of benefit, your death benefit's going to decrease by more than 200,000 in almost every case scenario, whether
yeah,
you're 80 or whether you're 40, but as we get into it, if you're 40 years old, you might have a greater hit to your death benefit than 80, and it just comes down to the company's way of calculating that, which we'll dive into
yeah,
the concept of that. But I
yeah.
just think it's important to know.
Yeah, yeah, and that's a big piece of it. So yeah, we'll definitely hit on that, and we'll actually look at two examples of how it works is at two different companies there. But before we get to that, I know everyone wants to get to. We will show an illustration on here, so all of you who are waiting for that, just hang tight. But we have common misunderstandings. So first, this is not true long-term care insurance. It can cover long-term care needs. It can be a great supplement, but it's not going to be a guaranteed full coverage solution. It's not going to be, you can't get an unlimited benefit like you can with some actual long term care coverage. And it's not designed to give you the most long term care benefit for the dollars going in. First and foremost, you're getting a life insurance policy. So you may get the most benefit out of the death benefit, but it's not meant to be coverage for that. I had a lady talked to a few weeks ago that they came in and they were all about they wanted chronic illness protection, and as we got to talking, turns out they already had a significant amount of death benefit. They were really just looking for long-term care, and so that's the route that we actually went, and specifically kind of a OneAmerica true hybrid version where you're going to get a lot more care coverage versus death benefit coverage. So each tool has a job. Make sure you understand what you're wanting before getting this. And this is really an added benefit, which, like you said, options. That's what we're all about. Gives you another option that you can use, but you don't have to use it. You can just keep a death benefit growing and going if a care need arises. Obviously, best use cases, like I just mentioned, supplemental, simple, and something versus nothing. If you have no long term care, great. Now you have something in place that can be used there. And if you're already getting permanent insurance, the rider's on there. So it's a great benefit, but not something to stress about. Hey, I got to pick the company because I like their benefit better. There's a lot of other reasons to pick a company rather than how they calculate this. And so that's what we'll look at. Three ways the money gets paid, because at the end of the day, that's what we want to know. How do we actually use that money? How do we get paid? But there is no free lunch, like we mentioned. It's a free rider. You're not paying for it. But when you actually use it, that's where the cost is going to show up. So first, get the haircut, which I don't know much about haircuts, but here they cut your hair, and so you get less than what you actually give up. So you accelerate $200,000 that you can have come to you. Your death benefit might drop by $250,000 or $300,000. So you're getting the benefit, but you're giving up less. You're not giving up less. Your beneficiaries that you would have passed on are actually the ones kind of missing out there. So that's something
Justin, I'm
important to note.
surprised you haven't called this the shave. The
Yeah,
shave.
I
We're gonna
should call.
shave off, but but yes, yeah, I like that analogy of the haircut.
Yeah, see the shave, there's nothing left, so that would be a bad benefit. There's gonna be something
The
left
total
for you.
chop,
Yeah,
the removal. Yeah, we don't want that.
yeah, don't want all of it gone there. Yeah, so that's one. Then you have the IOU. So thing it's just in advance, but they're going to charge interest on that. So it's not going to drop your death benefit in value by more, but the longer you have that outstanding, it is building
Mm.
interest from that. So it's going
So
to
it's
be
similar to like an outstanding loan.
yeah, exactly. It's going to be very similar to that. That you could just, hey, I'm going to borrow from my policy, or I'm going to accelerate the death benefit. Would work very similar to that. A lot of that would just depend on, hey, if you're early in a policy, guess what? You're not going to have very much cash value built up compared to the death benefit, and that would be a reason. Yeah, we need to accelerate if you needed more than what you had there. But yeah, that one. And then you also have the pay as you go. This is more of the true long term care type of coverage. So it'd be an actual long term care rider. You would pay for that and you would know the benefits that you're actually going to get. It's not going to be, hey, what do we want? It's going to be, you can activate it. You have a ceiling. Typically, that's going to be monthly income coming from it. So maybe, hey, we added this benefit. We know if we ever need coverage, we can get 5,000 bucks a month to at least supplement something there. So those are the three methods. Now we're going to actually look at some of the companies. So look at some of the companies and dive into what comes across there. Now, Penn Mutual, and I'm going to share my screen here. And so Penn Mutual is what we would call the haircut, right? So they're going to take a portion that's more than what they are giving you. I like their example here. Obviously, it doesn't go into a ton of detail, but I like that. It's simple right here. If you were age 59, you started this at 40, you get to age 59, here's going to be the actual benefit payment that you can get here. So you can get that benefit. Now, quick side note on that benefit. This benefit, you may be wondering why it's 156,950. That's actually the IRS per diem limit. So it's about $430 per day. And so they show that technically you might be able to get more than that. But anything above that may be taxed in some way or another. Now, that number typically rises with inflation as it has in the past, but that's what it would be at right now. So, side note, something to keep in mind. But you'll notice a few key things here, and this is going to be across any that are the haircut version. Is you're paying premium, right? So you're paying $10,000 premium immediately after you accelerate the death benefit. What happens? Well, our premium drops because we pulled money out. We no longer owe that much. We're not buying as much death benefit now, which is, you could look at that as, oh, great. If I'm pulling that, now I don't owe as much premium ongoing. You also have your cash value is going to drop. Face amount is going to drop. Really, that's just the base face amount. We want to look at the total death benefit here. And you'll notice here that we pull out $156,000. That's what is accelerated. But our death benefit here actually drops by more than that. And so this is what I'm talking about whenever we talk about, well, hey, how much is my death benefit actually going to drop there? It's $278,000 is what our death benefit drops. So you get $156,000 for a free rider. How much did that actually cost you here? Well, it cost you actually about $120,000 to get that benefit.
Well, and it looks like you have less cash value as well, which means that
Correct.
there's might be a version of cash value and death benefit that get part of that equation.
Yeah, yeah. So it's going to be all lumped in together. Yeah, you have less cash value because now there's less death benefit and so on from there. But that's where the immediate big difference is going to come from, the actual death benefit that you see dropping pretty significantly. Now, like you mentioned at the beginning, this person's 59. If they were 80, that benefit is going to drop less than what it actually would there because they're factoring in different things here. And this is just an estimate time at, hey, what's the interest rate and everything at that time.
And I just want to also be clear that with Penn Mutual as an example, it's just a one-time deal. So if you were terminal, but you happen to live longer than a year, let's say 2 or 3 years, it's not like you could get 156,000 each year. It would just be a one-time deal.
Yeah, and so this would be the chronic one. The terminal one, they have, you can actually get a little bit more. It would still drop it some, not maybe as much. The chronic one, they're looking at, hey, yeah, you could take this same amount next year if you wanted to, and it's going to drop that death benefit. Maybe not as much, but it's still going to start
I
dropping it
see.
down. Or if you actually had to use it every year, so you had 10 years of care, well, that death benefit is going to start to actually end up being pretty small. Typically, they have where there's going to be some death benefit left you can't take anymore, and there's a small death benefit left, so that something still gets paid out. But that's something to be aware of. Is, I would tell people, if you have long term care coverage already, let's use that. That's
For
specifically for
sure.
that. If you have other assets, great. Maybe we want to use those, but it's just another option that you may or may not want to use. If it's your only option and you can get the care, just like you know somebody who used that, they're
Mhm.
alive because they were able to pay for that. Now that, oh, life insurance saved their life, but they had an option that really helped out
Mhm.
in their situation. So,
Well, and you what you could do is you could also just take a loan against the policy in this
yeah,
scenario, and you would have less cash value available, but your death benefit would take less of a hit because it would the net death benefit would go down by whatever you took plus interest.
course
And
that, yeah.
so that is another thing to look at, is to weigh that option as well.
Yeah, especially knowing, hey, hopefully it's a short term thing, and then hey, you're right back. You could perhaps repay that loan if you wanted to, because that would be something that's going to build up. You take it at 59, no way to repay it back. Well, now you have interest building up. I mean, you could switch the dividends to slowly pay that down, but again, all options that having cash value, having that death benefit gives you those options.
Yep, that makes sense. And also we went through this pretty quick, but if they were older, their equation would be affected a little differently, because what they're essentially doing as they figure out how the effect of the policy is, all insurance companies have like a average age of when they think you're going to die. And so
Yeah,
obviously when, if you're going through this at 59, first of all, chronic illness at 59,
not.
pretty rare. Like, I would imagine terminal illness might be a little bit more than chronic, but let's just say you're at 65 or 70, the you're getting closer to the expected death period, and so life insurance companies have death benefit as a actual liability on there, because it's a matter of when they pay that out. And so they would, these numbers would only quote unquote get better as you get older, because you're getting closer to death.
Yeah. Yeah, as you get closer to death, they know, hey, there's not as much risk there. It's not like, hey, that's going to build up much. So they know they have that
Yep.
option. And that's where I'll be honest, you saying, yeah, people who are younger, probably less chance of that happening. But say you do actually have a chronic illness, maybe it's short term, maybe you don't have any disability income, your death benefit, your cash value hasn't built up much because maybe you recently got the policy. Now all of a sudden,
Right.
that becomes a maybe that's a more needed option at that time just to pay the bills. Yeah, we'd want
Yes,
to cover that with other assets, but maybe you can't. And that's where this becomes, hey, glad that you have it on the policy and hopefully you recover and then you keep everything going, death benefit and all that going forward. So
I see. Cool.
definitely just a big piece there. But yeah, back to so Penn Mutual, that's going to be the one that's the IOU. Actually, most of the companies we'll look at are not this way. They are like Lafayette Life, which is the lean version of it. And so Lafayette Life has terminal and chronic all in one. They don't have Penn Mutual has it separated: terminal illness rider and chronic illness rider. Lafayette Life just has one, and it's just the accelerated benefit plus rider. They have also the not plus rider. Part of that's going to depend on your health and what you can qualify for at the time there. So we'll just work off of this one. And like I said, this one is in advance. It's going to come to you. They're not going to drop that death benefit, but you're going to be building up interest during that time. And so we'll look at this one as well. And these are the only two we're going to look at because it's great examples. Not all companies have this illustrated, but Penn and Lafayette Life give you a good example of the lean method, and the IOU is the lean method, but the haircut, that one. So right here, same thing. We're going to look at the chronic illness here. These are the non-guaranteed values. So of course you're getting dividends. We'll just come out 10 years into the policy. So what you'll notice is hey, you can take periodic payments. So you can get up to $300,000 there, and that would come in periodic payments there. So they're listing it higher than what you could at Penn Mutual. Doesn't mean you can't get more at Penn Mutual. That's just what they're going to list it at, and they have a maximum of $300,000 that you could get at least without the lump sum. Then, if you get the max lump sum, so you just take that money, and this would be the maximum. You probably wouldn't do this unless you just wanted to. But if you do the math here, your death benefit minus this amount and the remaining death benefit is actually going to be the exact same. So you're not paying for it right now. But if it is a chronic illness, well, next year, that is going to be accruing interest, which would be determined at the time you actually take that advance. And so that's going to be the big piece is, yeah, you didn't pay right there, but say you have 5 years of illness. Well, you did the max lump sum, so you can't take anything the next year. You have it all, and it's going to continue to build up and build interest that is going against you and lowering that death benefit even more.
Now, am I correct by saying it doesn't seem to affect the cash value, or would it
It
affect
wouldn't
your ability to take loans?
Yeah, so if you took out all of this amount here, most likely you would have a very probably no cash value left. They
I
don't
see.
show all of the details like Penn Mutual does, but yes, because you took that out, that lowers your death benefit to 172, which would mean that's lowered, and that therefore that cash value would be significantly lowered if there's hardly any left at all
I
there.
understand. Okay.
And then relatively the same terminal illness, you're just looking at you can take a max lump sum. Death benefit does drop slightly more there. So you see for the terminal, it's dropping a little bit more, but you're able to get a little bit more. Actually, yeah, max out about the same. And so there would still be a lean, but I mean, if it is terminal, probably not worry too much about that building up interest in most cases there.
Yeah. So just as an example, if you're 67 years old and you do take the lump sum, your death benefit, if you didn't touch it at all, would be 837,000. But you could almost get an advance on that,
Yeah.
600, maybe 700, depending on if it's terminal versus chronic. And
Yeah.
and then let's say you pass away at age 70, you would get anywhere from 172 to 115. Um,
Yeah.
and so yeah, I mean, it's, I actually, for what it's worth, like, it seems cleaner this
Yeah.
way. And I like how Lafayette has that laid out.
Yeah, and that's where I like, and this is how One America does theirs. This is how Guardian does theirs as well. So it's going to be a matter of most of the companies do it that way. A lot of times it's a little, it's easier to understand. You're not like, well, if I take it, what's it going to drop by? Where am I going to be at? You know, if I take it, it's going to build up interest there, a
Yep.
little more straightforward there. So I would agree. Do like that a little bit better for what it's worth.
Well, and you can see where it's like you could take a policy loan, but it acts as very similar to a policy loan, but you just get access to more. Which Penn
Yeah.
is the same. Penn is potentially the same way, but um, yeah, I think I think it's a good way to illustrate.
Yeah, and so I'll be. It's not listed there, but in the fine print at Lafayette Life, I believe you can take up to 40 um, percent or more. Is the not the obviously the lump sum you can take more, but as the monthly payments up to 40%, and Penn Mutual is going to be capped at 25%. So
Okay.
theoretically, yeah, just with that, you could take more at Lafayette Life than you could at Penn Mutual there. So definitely a lot of little nuanced details between how each one works there. And then coming to One America, not going to look at their illustration. They don't have it illustrated for you, but One America works very similar to Lafayette Life. They have a terminal and they have a chronic illness rider at no charge. Now, chronic illness rider does depend partly on their underwriting. So that's a big thing to mention is sometimes you may qualify for the terminal illness, but not the chronic illness there. So at One America, part of it's based on if you get a substandard rating, you may not get the chronic illness rider on there. Or if you're a certain age, no chronic illness rider available for you. So not that if you're going for that and they have everything else you want in a policy, may not be a reason not to go with them, but just something to keep in mind there. And then, as you know, and most people do, I know Alden's been on here and talked about it. They have very good hybrid products that is more geared towards true long term care coverage. So you would have an annuity product that you put a lump sum in, it's going to build and be used specifically for long term care. Also, have a whole life product where you put in, and if you never use the long term care, well, you get a death benefit. If you use it, you can get significantly amount
Yep. If someone,
an amount.
again, going back to the client that came to you with, a desire for care, you definitely want to go a different direction if that is the outcome that you're trying to accomplish. This is a added benefit that gives you option, but I don't think anyone in their right mind would say, "Hey, in a perfect world, we're gonna depend on this
Yeah,
for
yeah,
care." It just is it gives you an option, and in some cases is the only option. And if that's the case, it's better than nothing. But
yeah,
it's if someone
anything like that. Yeah, it's really a matter of like, yeah, what are you trying to solve for? And if it's a matter of, hey, I can take $300,000 out of my whatever portfolio, $2 million that I know I can set aside. Long term care is covered. If I never use it, I'm going to get a death benefit from it, and that is passed on. Then that's a great way. Now you don't have to worry about that. Now it's covered, and that would be specifically for obviously long term care. Of course, you want to make sure your death benefits covered. Lots
Yep.
of protection pieces in
And
place, plus growth.
not
Yeah,
to get too philosophical here, but if you had permanent life insurance in general, it gives you a lot of options because you can look at every other asset as a, hey, I could potentially spend this down quicker,
yeah,
and I have the backstop of the death benefit. But you also have to look at taxes and factor that in as well. I would imagine
yeah.
that these riders come and there's no taxable consequence to it.
Yeah, that's for the most part. Now it may be slightly different with actually the chronic illness rider and everything. And it's not taxable up to a certain extent. Now, if you start looking truly for the long term care, and you have a lot of times now, not specific tax advice, you want to make sure, but you can take qualified money, roll it into potentially a like one of the annuity care products, and then it stays in there. And then if that is ever actually needed, that long term care may be coming to you tax free there. So some different tax planning you can actually do to help get long term care covered and give you a little advantage there as well. So something to keep in mind. But yeah, that is One America. Now we got Mass Mutual. Mass Mutual does it a little bit different. They have the terminal rider that's just going to be on there, no charge, very similar to the other ones. But then you also have two paid options actually at Mass Mutual. So majority of theirs won't have necessarily that chronic illness rider. They're going to have a long-term care access, I believe is what it's called, or they have just a kind of a cheaper chronic illness rider like you see. But most of those are actually going to be you pay for that. It's a small charge to pay for it, depending on the value you want. If you just want it added on there, but it's going to give you a little bit more of a defined benefit there. So really just depends on most policies are not going to have it unless you specifically want it added there for one reason or another. But otherwise, you can do something very similar to Guardian, have the long-term care rider where you know that benefit, even if you are paying for it up front. Yeah, that's Mass. And then Guardian, again, lean based. So it's the IOU. It won't necessarily drop your death benefit immediately, but it is building up interest. And they have the accelerated benefit rider, or enhanced accelerated benefit rider is what theirs is called. And then it is also one going to be they have a long term care rider you can add. They're separate, they're different. Long term care rider you pay for, the chronic illness rider, accelerated death benefit rider, you do not. And Guardian, again, is one that, depending on underwriting, like any substandard rating, typically you will not be able to have the accelerated benefit rider on that policy. So if it's something you really want, have a substandard rating, that's going to definitely affect things as they go. But those are the main companies. They all have their subtle differences, but are also all very, very similar as you look there. And so a lot of stuff just to hit on what actually drives the payout. So interest rates, life expectancy, policy size, pretty self-explanatory. The bigger death benefit you have, the bigger you'll be able to take out of it. And also each carrier has their own kind of assumptions and different things there. But the big thing is, as you look at the riders, none of those differences are something that you would choose a policy over one or the other. They're very small, nothing dramatic. But the dramatic difference would be if you actually said, I want long term care, you can get a lot more benefit for the same dollars going in long term care coverage, but a smaller death benefit. And so that's where it all comes back to what are the goals? If not, if you don't really looking for a specific long term care coverage, then hey, it's just an added benefit to the policy you are already going to get in place, and gives you lots of options, like I know we have said. But yeah, that is
That's
any
it.
other thoughts. I know that's
I know. I think it's I'm impressed that we went for about 30 minutes on this topic. So leave your questions down below, and if you want us to do a policy review of your policy and educate you on what type of rider you have and how it works, we'd be more than happy to help dive into that. And then obviously, if you have questions about just your a policy in general, or does this make sense, we specialize in helping you get clarity on, does life insurance, when integrated properly, make your situation better, and we actually help you implement it if it's something that you look at and say, I want this. So that's what we specialize in. We work with people all around the country. And Justin, you are one of our amazing coaches and have walked people through on a day to day basis what this could look like. And so we appreciate you. And also, if you like this type of content, let us know, and let us know if you want us to go in detail about other specific benefits, pros and cons to life insurance. We want this channel to be everything, all things life insurance. And so, Justin, thank you, and very much look forward to hearing and seeing the comments.
Yep. Thank you.